Welcome to the Deep Dive, where we take a massive stack of complex research, in this case raw real estate metrics, and really just distill it down into the insights you need to feel confidently informed. And today, we need to forget the national headlines about the housing market. Those stories, they just gloss over the fact that housing is so fundamentally hyper-local.
It really is.
Our mission today is laser-focused on the realities of the North Texas region. We're looking specifically at the data snapshot for October 2025. I mean, this area is massive, dozens of counties, and the story changes block by block.
And that's exactly where we have to cut through the noise. To get beyond anecdotes and, emotional selling, we rely on the definitive source for this entire region.
Yeah.
The data is provided by the North Texas Real Estate Information Systems, Inc. If you see the acronym NTREIS, just know it's pronounced NTREIS.
NTREIS, got it.
And this is the gold standard. It's the raw, refreshed market metrics that every real professional is using. This isn't Zillow. It's not some snapshot. It's the full book. It covers everything from dense Dallas, Fort Worth, all the way out to the farthest counties.
So it lets us see what's actually happening on the ground.
With precision, yes. Supply, demand, price movement, it's all there.
Okay, so let's unpack the overall thesis first, because the whole atmosphere has dramatically changed. If you were house hunting here 2, maybe 3 years ago, it was the Wild West.
Oh, absolutely. A wild frenzy.
Gave inspections, cash offers, sellers felt invincible.
Yeah.
What's the overarching context now? What does this October data tell us is the new narrative?
The new narrative is defined by what we're calling market softness and, I think, critically, transactional gridlock. The frenzy is gone. It's been replaced by this deep tension. We have elevated interest rates hovering around, 6-7%, which are making a huge segment of buyers really hesitant.
They're just waiting on the sidelines.
They're waiting for a dip. But at the same time, we have this massive population of potential sellers holding on to what you could call golden handcuffs.
Right. They've got those amazing mortgage rates from a few years back.
Exactly. They locked in fantastic low rates, sometimes at 3% or even lower, and they are extremely hesitant to trade that monthly payment for a current one that might be $1,000, maybe $1,500 higher.
So they're trading a P&I payment of, $2,000 for one that's going to hit $3,200 today just to move next door.
Yeah.
That $1,200 difference is a premium they're just not willing to swallow unless they absolutely have to.
Precisely. And that creates the staring contest we're seeing everywhere. Buyers are waiting for prices to drop further to kind of offset the high rates, and sellers are waiting for rates to fall so they don't have to give up their mortgage.
So the market isn't collapsing, but it's just slowing down.
Dramatically. Because of this transactional friction, I like to say the engine hasn't stalled. It's just running in a much lower, much more complex gear. It demands a lot more finesse from everyone involved.
A lower, more complex gear. So basically, we're back to driving a manual in rush hour traffic. Lots of friction, frequent stalling.
That's a great way to put it.
All right, let's start with the big picture metrics across the entire Dallas Metroplex to confirm this softness. When we compare October 2025 to October 2024, what are the baseline indicators?
Well, the metrics tell a really consistent and undeniable story of expanding supply and cooling prices. Year over year, it's very clear.
Okay, so start with inventory.
First, inventory growth is significant. Total inventory across the whole NTREIS region is up by about 7.4% compared to last year. That's a total of 50,080 units now available.
50,000.
50,080, yeah. So to put that in perspective, that's 50,000 other homes competing for the attention of the same limited pool of buyers.
Wow. That is a critical number. It immediately confirms that shift in leverage, right? More options for buyers just means more pressure on sellers, especially the ones who still remember the bidding wars. So what does that rising inventory do to prices?
It leads directly to price softening. It confirms that the high-rate environment is finally pressuring list prices. The regional median sales price is down 2.7% compared to last year, settling around $360,000 for October.
Okay, 2.7% might not sound like a huge drop to some people, especially after the gains we saw.
It doesn't, but after an era of nonstop double-digit appreciation, seeing any consistent annual decline is a major psychological shift. It signals the definitive end of that rapid appreciation cycle. It tells sellers they cannot rely on the market to just cover an inflated price tag anymore.
And the third major metric we always watch is speed, days on market, or DOM. That's a real measure of how efficiently things are moving. How much longer are houses taking to sell now?
Days on market is the indicator that most dramatically illustrates the gridlock. DOM is up almost 12% regionally.
12%.
Homes are now averaging 66 days on the market before they get a closed deal. That is a critical number for every single person to internalize.
66 days. Wow. That feels glacial. I mean, it's agonizing for anyone who bought or sold in 2021 or 22 when houses were just gone in a weekend.
It absolutely feels slow, but this is where we need that historical perspective.
Okay.
66 days is actually a normal, healthy, functional timeline for a real estate transaction. What we saw a few years ago, 20, 30 days, that was an anomaly. It was a frenzy fueled by ultra-low rates and just extreme scarcity.
So this 66-day average means patience is back in the picture.
It's mandatory. Patience and strategic pricing are mandatory. It means the market requires a measured process again. Staging, marketing, tours, negotiation, appraisal, underwriting, all of it takes time.
Wait, I have to challenge that a little bit. That 66 days is normal and healthy. For a professional investor, maybe,
Yeah.
But for the average seller who needs certainty, the family with kids relocating or the couple needing to downsize, 66 days is 2 months of maybe carrying 2 mortgages.
It is.
Paying temporary rent, scrambling logistics. Doesn't that high DOM number contribute directly to the friction and gridlock we talked about?
It absolutely does, and that's the tension point. You're right. While it's healthy for the system because it allows time for due diligence and accurate appraisals, it's painful for the individual.
Right.
It drains their resources and their patience. The operational friction is real. Longer DOM impacts lenders who now need to recalculate rate locks more. It impacts appraisers. The entire machinery has just slowed down, and it demands a higher level of preparation from the homeowner.
Okay, so let's shift to transaction volume or velocity. We have more homes sitting longer. Are they still actually selling, or has the whole pipeline just clogged up?
Homes are definitely still selling, but the slowdown is noticeable, especially in the lead indicator, which is pending sales.
Okay, so the ones under contract but not closed yet?
Right. Pending sales decreased by a steep 8.7% regionally. That's down to 8,569 units. This shows that the rate at which buyers are willing to commit is clearly slowing down.
But the completed sales, the final numbers, they showed a much smaller dip. Why is there that discrepancy?
That's the interesting lag effect we always see in this data. Closed sales, the completed transactions, showed a minor drop of only 1.7%, which is 9,324 units. This tells us that deals made a bit earlier, maybe in August or September when things were a little faster, are still finishing successfully. But the pipeline of new successful deals,
Represented by that big 8.7% drop in pending sales.
exactly, that pipeline is shrinking. That lower pending number today usually means a larger, more dramatic drop in closed sales next month. The market's losing momentum.
And that brings us to buyer leverage. The flip side of all this. How much power do buyers actually have right now to negotiate off the asking price?
Well, the metric here confirms the growing buyer advantage. We look at the percent of original list price received.
Okay.
And this number used to be comfortably over 100% during the peak. People were paying thousands over asking just to win.
I remember that.
For October 2025, that percentage is down 0.8% year over year, and it's landed at 93.4%.
93.4%. That's staggering. That means, on average, sellers are conceding nearly 7% off their original list price.
That's right.
That 7% is basically the price of optimism. The cost of coming to market thinking you're going to catch the peak, only to find buyers are ruthless now.
Exactly. This confirms the initial list price is often just aspirational, a fantasy even. Buyers are now expecting and getting significant negotiation leverage. If you list your home for $400,000, the data suggests you should prepare to sell for around $373,600.
So listing high and hoping for the best is a failed strategy in this 66-day environment.
Completely failed. You have to price effectively from day one to avoid chasing the market down over those 2 months. It just signals desperation to buyers.
It's a return to strategy over blind luck. The Wild West is closed.
While the Metroplex average sets a good background, real estate is, as you said, hyper-local. We have to drill down. And when we look at the major counties, Dallas, Collin, Tarrant, Denton County is a particularly complex and fascinating case study. It's a story of resilience battling a massive supply influx.
Denton has always been that high-growth, super desirable suburban area, great schools, master-planned communities. But its story is diverging from the regional softness. So where is Denton showing resilience?
Surprisingly, in closed sales volume. Despite all the macro pressures, rising rates, higher prices, Denton County saw a slight increase in closed sales for October.
An increase.
Yep, up 0.2%, a total of 1,091 closed sales. This tells us that absolute demand is still incredibly high and active in Denton. People still want to live there.
Okay, so the demand is there, it's steady. But what's the critical challenge facing Denton sellers? This is where the sheer volume of supply finally breaks through, right?
It's the single most critical challenge. It's why Denton is the poster child for this market shift. The massive influx of new inventory in Denton is just overwhelming that steady demand. Inventory jumped sharply by a staggering 19.2% compared to last year.
19%.
19.2. We're talking about 5,381 homes for sale sitting on the market in Denton County alone.
Wow. A 19% growth in competition year over year is immense. That kind of supply flood, even with steady sales, has to cause a serious price correction.
It has, dramatically so. Denton had one of the sharpest price adjustments in the larger markets. The median sales price adjusted downward by a steep 7.9%.
7.9.
Down to $437,250. That massive influx of listings, those 5,381 homes, explains why Denton's correction is so much deeper than the Metroplex average of 2.7%. The sheer volume of choice has, well, it's weaponized the buyer.
Okay, but if I'm the Denton homeowner who bought in 2022 near the peak for, say, $470,000, hearing an 8% correction might trigger some panic. We should acknowledge that pain point.
We have to, and we have to frame this not as a collapse, but as the market aggressively correcting from unsustainable speculative highs.
This is going back to reality.
Exactly. Denton was maybe the hottest county in North Texas during the frenzy. A 7.9% drop is painful. It definitely impacts peak buyers, but the median price of $437,000 is still very healthy when you look at the historical trend before the pandemic.
So long-term equity is probably preserved, but the froth is gone.
The speculative froth, the money paid just for the privilege of winning a bidding war, has been entirely squeezed out.
So what does this mean for a current seller there?
It means effective pricing is absolutely crucial. Listing even slightly above where the market actually is, even 1% above, means 5,380 other homes are going to look better priced than yours. You will sit, you'll collect negative attention, and you'll eventually have to drop your price below what you could have gotten if you priced correctly on day one.
Let's use the ultimate market health indicator here. Month's supply of inventory. This is the metric that tells us exactly who holds the power in Denton.
Exactly. Month's supply estimates how long it would take to sell everything if no new houses were listed. Denton's month's supply is up to 4.5 months as of October.
And remind us, what does a balanced market look like?
A balanced market where neither side has a clear advantage is typically around 6 months of supply.
Okay.
So, while 4.5 months is way higher than the 1.5 or 2 months we saw at the peak, Denton technically still favors sellers slightly.
But the trajectory is the key insight here.
It is. The sharp increase in inventory, that plus 19.2%, is driving this figure rapidly towards 6 months. So if you list today, your property will likely sit in a 5, maybe 5.5 month supply environment by the time you close 66 days from now.
So Denton is moving fast towards a balanced or maybe even a buyer's market.
Very soon, if this trend continues, the balance of power is shifting week by week.
We've established the new normal for the Metroplex and seen Denton get hit hard by that inventory wave. But here's the kicker. The average numbers we just discussed completely hide the terrifying volatility at the edges of the map.
Oh, yeah.
Now we look at the places where the mean never existed, the true Wild West of our data set.
This is where the NTREIS data gets wild. But we have to be extremely cautious in how we interpret it. We see counties reporting what look like just astronomical, unbelievable changes. But we have to remember the context. Small transaction volume. In small rural counties, the median price can be mathematically distorted by a single sale.
So one big ranch sells one year, and 2 small starter homes sell the next, and it looks like a market crashed.
Exactly, or the reverse.
All right, so let's list some of these incredible percentage shifts for price gains. These numbers really jump off the page and challenge that market softness narrative.
They absolutely do. Take Stevens County. It saw an astronomical growth in median sales price, up a shocking 130.0%.
130%.
To $257,000. Rains County also jumped 88.8%. Callahan County up 79.2%, and Palo Pinto County saw its median soar by 70.7%.
In a market of gridlock and softening, these gains seem totally counterintuitive. So what's the fundamental insight?
The insight is the distortion of low volume. Stevens County, for example, only had 11 closed sales in October.
Just 11.
So if 3 of those sales were significantly higher than last year's average, maybe from people moving out of the city looking for acreage, that 130% spike is just math. It's not a sustainable boom. The lesson is, for these counties, the median price is meaningless. You have to look at the specific comps.
Okay, speaking of dramatic shifts, let's look at the price drops. Some of these are absolutely massive.
We saw several counties with truly huge drops. Shackelford County takes the prize for the most extreme volatility. Let me stop you because this number is staggering. The median price plummeted an astonishing 92.7%.
92.7.
Down to just $20,000.
Is that even real, or did the county sell a parking lot last year?
It highlights exactly why you can't rely on macro data for micro decisions in these areas. Shackelford County had an extreme change driven by very few sales. We also saw Nolan County fall 55.6%. Montague County had a steep drop of 41.2%, and Freestone County dropped 37.8%. For anyone in these markets, the price is dictated almost entirely by the current sales mix. It's just fundamentally unpredictable.
So high risk and low liquidity.
The definition of it.
But the volatility isn't just about price. It's also about raw transactional surges. Are there any outlying counties that saw explosive growth in actual sales, showing pockets of new demand?
Absolutely. Even while the Metroplex overall dipped 1.7%, some outlying areas surged. Upshur County saw closed sales increase by an astounding 300.0%.
100%.
It sounds like a tidal wave, but really it's just moving from 2 homes closed last October to 8 homes closed this October.
So 6 more families moved there.
Exactly. Huge growth, but still a tiny market. It shows that when affordability is reached, even with high rates, transactions happen.
Any others?
We also saw Young County surge by 142.9% from 7 to 17 homes, and Brown County had a large gain of 61.3% from 31 to 50 sales. These surges show pockets of intense, yet often inconsistent demand in areas where the entry price is just so much lower.
Moving back to the operational health of the overall Metroplex, we have some metrics that give us important context about whether this softening market is actually healthier for consumers in the long run.
Right. And let's look at the structural problem of affordability.
Affordability has been the massive long-term problem here for years. Prices outpacing incomes. What does the Housing Affordability Index, or HAI, tell us now?
Okay, before the number, let's just quickly remind everyone what HAI means. A score of 100 is perfect affordability. The median income is exactly what's needed to qualify for the median home.
Got it.
The good news is that the Metroplex HAI increased by 5.6% to 95 in October.
So we're still technically short of 100. The median household income is 95% of what's necessary. Right. But that upward trend is crucial. What does that 5.6% increase really mean for people?
It represents a significant step toward market health. That upward trend is a key benefit of softening prices paired with stable regional income. It tells us that the 2.7% median price drop is actually starting to make housing more accessible.
The ecosystem is trying to correct itself.
It is. The high interest rates are still throttling the index, keeping us below 100, but the trend is a necessary correction.
That stability is important. But let's go back to that key operational shift. The slowing pace, the days on market. The year-to-date average for the Metroplex is 63 days, up almost 17% from last year. We talked about how this feels for the seller, but what's the operational impact for the industry?
The operational impact is a fundamental shift in how the real estate industry functions. When homes sell in 20 days, the process is streamlined. Appraisals are easy. Financing is fast.
Right.
When the average hits 63 days, every step lengthens. For agents, it means carrying a much larger client list for longer, raising marketing costs. For lenders, it increases the complexity of rate locks and potential requalifications if a buyer's situation changes.
And what about the appraisal process? That's where the 63-day wait often causes the most pain.
Absolutely. Longer DOM means appraisers are working much harder to justify value, especially in softening markets like Denton. During the frenzy, prices were self-justifying. Now, if the buyer and seller agree on a price on day 60, the appraiser has 60 days of softening market data to contend with.
So the risk of the appraisal coming in low goes up.
The longer the DOM, the higher the risk of the house failing to appraise at the contract price. That forces you back into negotiation, or even leads to a collapse.
To illustrate this, let's compare the fastest large county to one of the slowest.
The contrast is jarring. Dallas County is moving the fastest among the large core counties, with an October DOM of 54 days. Still nearly 2 months, but faster than the average.
Okay.
Now, contrast that with Calming County, an outlying market where homes sat on the market for an astonishing 202 days in October.
202 days.
An increase of nearly 70% year over year.
So if you list a home there, you should expect a process that spans over 6 months. That's nearly half a year of uncertainty.
It requires a complete shift in mindset. From a transaction to a marathon, you need a calculated marketing plan designed for endurance, a deep financial cushion, and just extreme patience.
Okay, finally, let's analyze the long-term trends by looking at the year-to-date figures. This tells us about the structural accumulation of inventory over the whole year, not just 1 month.
And when we look at the YTD figures, the pattern of inventory accumulation becomes inescapable. New listings YTD are up significantly in key growth areas like Collin County, up 18.3%, and Denton County, up 13.9%.
So people are willing to list their homes. Necessity is finally outweighing those golden handcuffs.
It seems so, but the closures aren't keeping up with that massive volume. The supply side is accelerating while demand is just sputtering along.
So what's the final number on closures?
Closed sales YTD are barely up regionally, only a 0.9% increase. So when you have a massive surge in new listings, combined with almost flat closure growth, the defining structural feature of this market is inventory accumulation. Power is inherently shifting away from the hesitant seller. If they wait, they just add to the pile.
This brings us to the most critical part, strategy. For all the listeners who are potential sellers holding that low golden handcuff mortgage, say, trading a 3% for a 6% rate, it feels impossible. What is the counter-argument to just waiting for rates to drop?
Well, the core counter-argument is really centered on quality of life and the diminishing returns of equity preservation. If the reason you need to move is necessity, a growing family, a job relocation, downsizing, that quality of life often outweighs the cost of waiting for a hypothetical rate drop.
Because we don't know when rates will fall. It could be months, could be years.
Exactly. And while you wait, your home's value might actually shrink more than any interest rate savings would compensate for.
Right, as we saw in Denton with that 7.9% correction.
Precisely. The equity erosion you suffer while waiting might cancel out any minor savings if rates eventually fall. You might save on the rate, but lose substantially more on the sale price.
So if you decide to list in this high inventory, slower market, what does the data demand in terms of flawless execution? Especially in a place like Denton County, where inventory is up almost 20%.
Flawless execution is just non-negotiable. If you are one of the 5,381 available homes in Denton, you have to be in the top 10% of that pool to sell.
And what does that mean practically?
It means 3 things. First, professional staging and preparation. Your home has to look like a model home. The 66-day buyer has time to be picky. Second, a precise pricing strategy that is aggressive from day one. List at or even slightly below where the comps suggest the prices.
To avoid going stale.
And avoid those price cuts that signal desperation. And third, aggressive marketing. You have to use the full range of tools to capture the few active buyers. You just can't afford to miss the market by 5% on your price and then waste 60 days trying to catch up.
Okay, so if the seller's path is treacherous, what's the clear opportunity for the move-up buyer right now?
The opportunity is immense, mainly because the civilized way of doing business is officially back. It brings power back to the consumer.
How so?
First, they can actually negotiate prices down, as we saw with that 93.4% list price received metric. That almost 7% concession is now standard procedure.
And it's not just the price, it's the terms of the deal itself.
Absolutely. Second, buyers can confidently ask for significant seller concessions, like contributions toward closing costs or funds to buy down their mortgage rate. And third, they can request and often get repairs after an inspection.
Which was laughable 2 years ago.
A seller facing a 66-day DOM is far more likely to agree to a few $1,000s in repairs to save the deal now.
And the ultimate benefit is just simple choice, which has been weaponized by the sheer increase in supply.
Exactly. More choices lead to better matching. When only 2 houses were available, you settled. When 5,381 are available, as in Denton, you can afford to be highly specific. Right school district, right floor plan. This increased inventory has fundamentally empowered the consumer who is liquid and ready to act.
That brings our deep dive into the North Texas real estate data for October 2025 to a close. Let's quickly summarize the crucial synthesis we uncovered. The overall Metroplex is normalizing into a slower, more negotiated market. That's proven by the 66 days on market average, And the regional price softness.
It's the reversion to the mean we've been waiting for.
However, the story is splitting dramatically, and Denton County really exemplifies that.
Denton County is ground zero for this shift toward balance. It's undergoing a sharp price correction, down 7.9%, driven by that massive surge in inventory, up 19.2%, even though buyer demand is still relatively steady.
The core implication is that local context is everything.
Everything. The velocity and volatility of the market depend entirely on whether you're in a dense suburban center or a low-volume outlying county.
So the data is telling us that the market is splitting into two distinct narratives. And this is the final thought I want to leave you with.
The local market is splitting into these stable yet rapidly softening large markets versus areas with a thin, structurally deep oversupply in the outer rings. On one side, you have the high-volume, high-inventory centers like Denton, Collin, Tarrant, where price competition is fierce, the correction is sharp but steady, and transactions still happen.
And on the other side?
On the other side, you have the lower volume, more volatile outer counties. A single sale can create massive median price swings, but the inventory situation is fundamentally dire.
And what's the one data point that really crystallizes that difference?
Montague County. Out toward the western edge of the data, its median price dropped over 41%, but its month's supply of inventory actually increased to a whopping 13.9 months.
14 months of supply.
That isn't softness, that's a structural breakdown. When inventory supply stretches into 14 months, the question for a seller is no longer just how much they lose in a price drop, but if they can sell at all without a profound pivot in strategy.
A completely different ballgame.
It highlights the crucial difference between a market that is simply slowing down and a market that is structurally saturated and illiquid. And that difference is what every investor and homeowner in North Texas has to internalize today.